$7.4 billion. That isn't a rounding error. That's the size of a lie that ran for 8 years inside one of the world's largest retail companies. And nobody caught it until it was already over. Steinhoff International was, on paper, a retail giant. At its peak, the company operated more than 12,000 stores across 30 countries. It owned Pepker in South Africa, Mattress Firm in the United States, Conforama in France, and a dozen other household names across Europe and Africa. The man at the center of it was Marcus Joost, a South African businessman who had built what looked like a genuine global empire from a modest furniture business founded in the 1960s. Joost was celebrated. He sat on charitable boards. He was photographed with politicians. Steinhoff's share price climbed for years. And then, on December 5, 2017, it stopped. To understand what PwC eventually found, $7.4 billion of fictitious or irregular transactions spanning 2009 to 2017. You have to understand how a company this size can lie for this long. The mechanism isn't complicated. It is just brazen. Here is how it allegedly worked. Steinhoff allegedly created transactions with a network of related parties, companies connected to insiders, that didn't reflect real economic activity. Goods were allegedly sold and bought back. Revenue was allegedly booked that was never truly earned. Assets were allegedly inflated on the balance sheet so the company looked healthier, bigger, and more creditworthy than it actually was. Every year the accounts were filed. Every year the numbers grew. Lenders extended credit. Investors bought shares. Pension funds allocated capital. The machine ran because everyone at the top of the machine allegedly wanted it to run, and because the complexity of a multinational retail conglomerate operating across dozens of jurisdictions is genuinely difficult for any single auditor to see through in its entirety. For 8 years, allegedly, no one did. Then, in late 2017, a German publication began reporting on accounting irregularities at Steinhoff's European operations. Steinhoff dismissed the reports, but the questions didn't stop. On December 5, 2017, Steinhoff announced it had discovered accounting irregularities requiring further investigation. The same day, Marcus Joost resigned. He offered no detailed public explanation. He simply left. The share price fell 63% in a single day. Within weeks, it had fallen 98% from its pre-scandal peak. A company that had been valued at roughly $23 billion on international markets was worth almost nothing. Investors who had held shares the week before were holding paper. Pension funds that had allocated to Steinhoff, including major South African public sector retirement funds, had seen the value of those holdings nearly erased. There is a particular cruelty in what happened to those pension funds. We aren't talking about professional speculators who made a calculated bet. We are talking about teachers, nurses, municipal workers, people who had contributed to retirement funds for decades and had no say in how those funds were invested. More than 40,000 employees of Steinhoff-affiliated companies saw their pension positions devastated. Some lost the majority of what they had accumulated. The people who allegedly designed the scheme walked away. The people who had no idea it existed paid the price. The forensic investigation by PwC took years. When the report was finally completed, it was one of the largest forensic accounting exercises in corporate history. The investigators found that the $7.4 billion in fictitious or irregular transactions had allegedly been used to inflate profits, conceal losses, and support the appearance of a healthy balance sheet. The report ran to thousands of pages, It named individuals. It described structures. It was, in essence, an autopsy of a lie. Marcus Joost was eventually fined approximately $25 million by the South African Financial Sector Conduct Authority, a number that sounds large until you place it next to $7.4 billion. He was also facing criminal charges. South African prosecutors had been building a case for years. But on March 19, 2024, as the prospect of arrest became real, Marcus Joost died. The circumstances were consistent with suicide. He left no public statement. The criminal case against him, in its most direct form, ended there. Steinhoff itself limped forward for years in various restructuring attempts. Creditors negotiated. Legal claims were filed in multiple jurisdictions. A settlement framework was eventually constructed to compensate some investors and pension holders, though the amounts recovered were a fraction of what had been lost. In 2023, Steinhoff International was formally dissolved. The company ceased to exist. The brands it had owned, some of them, survived under different ownership. Pepker trades independently in South Africa. Mattress Firm is still open. The storefronts outlasted the structure that had allegedly been built on false numbers. In that sense, the fraud was almost invisible to the average customer, who simply kept buying mattresses and furniture, without knowing that the balance sheet behind the company had been allegedly fabricated for years. There is a question people always ask when a fraud of this scale is revealed. How did nobody know? The honest answer is that some people allegedly did know, or knew enough to ask questions and chose not to. The second honest answer is that complexity is one of the most powerful tools a fraudster has. Steinhoff operated in 30 countries, reported in multiple currencies, and conducted transactions through a web of subsidiaries and related parties that no single person could hold in their head at once. That complexity wasn't an accident. It was, allegedly, the architecture of the deception. The auditors signed off. The analysts rated the stock. The credit agencies gave Steinhoff investment-grade ratings. Every professional layer that's supposed to catch fraud failed to catch this one, or caught fragments of it too late, or raised concerns that were dismissed or buried. This is the part of the story that should make anyone who invests in large companies slightly uncomfortable. The safeguards are real, but they aren't infallible. And when a management team is allegedly determined to deceive them, the safeguards can be defeated. What is left after something like Steinhoff? A forensic report, a dissolved company, a dead CEO, 40,000 workers who can't get their pension years back, and a number, $7.4 billion, the documented size of what PwC called fictitious or irregular transactions, accumulated over 8 years, in plain sight, on audited financial statements. The lesson, if there's one, isn't complicated. It isn't about accounting standards or audit reform, though those conversations matter. It is simpler than that. When a company's growth looks too consistent, too smooth, too clean across too many geographies for too many years, that smoothness is the signal. Real businesses have bad quarters. Real businesses have regional problems. Real businesses have years where the numbers go the wrong way. Steinhoff's numbers went the right way, year after year, across a global retail empire, during a period of genuine economic turbulence. That was the tell. The accounts were too good. And $7.4 billion is what too good actually cost.